So the recession is here. The stock market is going to crash. The bottom is going to fall out. That's what everyone is saying, at least. I hear so much chatter. Everyone in the last week or two has become an economist. They're quoting this and that. And it's leading to some confusion, in my opinion, in the marketplace amongst investors. I have been investing for over 20 years for dividends, passive income, cash flow. I am already paying some of my bills with dividends. And the one thing, or one of many things that I bring to the conversation that I believe really belongs in the conversation is my perspective. I've been doing this for over 20 years, so I want to share with you today, someone who may be interested in investing in dividend stocks, maybe already has a dividend portfolio. Maybe you're not in dividend stocks, but you're just an investor. I'm going to share 4 pieces of wisdom today from my 20 years, from my perspective, that matter a lot right now. They matter a lot to anyone who is investing in this time when things are potentially volatile and when there's just a lot of chatter and kind of everyone's becoming an economist out there. And so the 4 things I want to talk about today are: 1, a recent stock purchase I made yesterday and what it means in the scheme of things as it pertains to the stock market we're in right now. 2, I want to talk about macroeconomics very briefly and the role that it plays in my own decision process. And 3, I want to talk about the purpose of all of this. Why am I investing in dividends? And I actually want to talk about S&P 500 index fund investors because I think they actually get a lot right. A lot more, quite frankly, than some dividend investors are getting. And then I want to close out today. So many of you have been asking about what I do in commercial real estate. I want to talk about it because I basically have a philosophy in commercial real estate that applies directly to dividend investing. And so the thought pattern is very similar. And I feel that the way I approach commercial real estate, it should be the way that dividend investing is done. It's certainly the way that I do dividend investing. And it's very different, very, very different than 99% of investors out there would ever look, in my opinion, at the stock market. And so I'm going to share some knowledge today, share some perspective in these crazy times. Get ready for another exciting video. So I bought 3M stock yesterday. I bought some more shares of 3M. I have been averaging down since 2018, and I bought more shares yesterday at $160 and change. I shared this on my Twitter, by the way. A lot of you already know this. And 3M, right after I bought it, proceeded to drop even more, and today it's down to a fresh low at $156.86. And so 3M is an interesting stock. I am basically underwater on every single purchase I've made on 3M at this point. And a lot of people who are newer to investing, they don't have my perspective. They may look at something like that as just, hey, Ian, that's bad. That's not good. And so I want to talk about that. But before I do, I want to talk about another stock. I also own shares of a company called Home Depot. In the Home Depot, I started buying at least in 2014 at $74 and change. Now it's up at $201. And so on that first tranche, I am up 171% on my Home Depot stock. And so 2 things I want to point out here. The reason I'm bringing up Home Depot is twofold. I have built-in gains. I have a lot of stocks like this. If you've been following my channel here on YouTube, you know that. You know my whole portfolio. You know the stocks I own. You know I've got some gains because I've been at this a while. Because I have built-in gains, it gives me the perspective. It gives me the confidence to enter new positions like 3M. It gives me a lot of confidence, maybe too much confidence at times, because I have built-in gains. And so the moral of the story there is for people who may be newer to dividend investing, people who are just starting out with dividend investing, it does get easier over time from kind of a overall portfolio standpoint, because at least what I found is once I've had these built-in gains and they're pretty substantial, it just gives me some breathing room. It just gives me kind of that ease, if you will, in my life, in my investing, just makes me feel a lot more comfortable, if you will, with my portfolio because I got the built-in gains. And so if you don't have the built-in gains yet, something to ponder that in the short run, yeah, it may be a little more tricky when you see volatility, when you see that you might be down on something. It may freak you out a little bit more, but just come to realize that one day when the built-in gains are in the portfolio, it gets a lot easier. So that's point one. But point two, which is actually more important, is this. I've only built half of my 3M position here. I've been buying since 2018. I still need to double. I could possibly triple the size of my position. It would be within the allocation I want. I love buying 3M as it trends down. I love this. And the reason I love this is it allows me to get a better weighted average cost. By dollar cost averaging in, I'm getting a better weighted average cost. And the reason for this is because it's impossible to time the low. And so that's point one. But point two is I don't have all the money to buy my full 3M position now. It's going to be a very big position. I have money rolling in monthly that I deploy in the market, but I don't have it all right away. And so by averaging in over time, especially in a stock that's going down, I'm getting a better weighted average cost in terms of value. And what's great with 3M is I believe after it's done going down, it's going to start going up. And what's great about this is I can buy all the way down, all the way back up. Let me contrast this with Home Depot. I bought Home Depot here at 74, and then it went nothing but up. And so I averaged up, 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 up. I didn't have the opportunity like I did with 3M. So with 3M, I have an opportunity. I'm buying down, and then I'll buy back up. With Home Depot, I just bought on the way up. And so this is perspective. If you're a long-term investor, if you're like me, you're buy and hold forever, you're buying for the cash flow. Maybe you're not even a cash flow person. Maybe you're just buy and hold forever. When an investor has a long-term time horizon, it is so, and when an investor is actually actively accumulating shares and trying to build a position, it is so exciting to be in a market where a great company, a company with solid fundamentals, yeah, they're facing some headwinds because talking about recession, because they're a leading indicator, if you will, of the economy. And because 3M is a B2B company, businesses can delay orders. They're starting to see some softness. It's slowing them down a bit. Yeah, hey, they're facing some trouble with their stock price, but look, the fundamentals are still rock solid in my opinion. And this is a company that has increased its dividend yearly forever, and I believe they will continue to. Anyways, when an opportunity like this comes to buy a fundamentally solid company at decreasing prices, at better and better valuations, and I already have built-in gains in my portfolio, so I got that confidence about my portfolio, it's so exciting. But I'll tell you, even before I had those built-in gains, the message is, sometimes it is really exciting to be in these shoes. It's not always easy when you're going through it, but it's so much better to be buying when it's going down versus up like I was with Home Depot. And I think in the long term, I'm going to be so happy with what's happened with 3M, and I'm going to be so happy once I built my entire position. And quite frankly, I hope it stays down, if not sideways, down for a very long time, because I have a very big position to build in 3M. So some knowledge for you today, some perspective from someone who's been doing this a very long time, that a down market, a recession, if you will, all this chatter, it's not necessarily a bad thing. And quite frankly, it could be a very good thing for people with a long-term horizon who are actively building portfolios. Because remember, if you're investing for dividends, lower share price means higher starting yield, means the money you deploy gets you more cash flow right away. That's just the simple math of it all. And so that is so exciting. More cash flow is always better. I only invest for cash flow. Don't even care about the capital appreciation. I talk about it though because it's what everyone uses as a benchmark. Okay, moving on to point number 2. This is really important, so pay attention here, because I think the community, not necessarily this community. Look, this community, I love you guys. Thank you for subscribing. If you haven't already, please consider doing so. It means the world to me. But I'm talking about the investing community online. Maybe not even online, everywhere. This idea of the recession is getting really hyped up right now. And I'm seeing a lot of people comment, quite frankly, on economic trends that, it's good. Look, this is dividend investing for everyone. Everyone should have opinions. Everyone should push to elevate their knowledge and be the best that they can be. That being said, let me tell you, the economists themselves cannot get it right. And these are people with PhDs who have devoted their lives to macroeconomic analysis. And so let me tell you a bit. For my job, I'm a commercial real estate developer. Part of my responsibilities at the firm that I'm affiliated with is I have to go to some economics forums and conferences each year. One that I'm attending online right now is called Malden SIC, Strategic Investments Conference. John Malden is the guy who hosts it. World-class economists speak at this event. And there's so many good insights. And so what I'm trying to say is, look, if you really want to get into macroeconomics, don't listen to me. Don't listen to the guy on Twitter who is brand new to the world of investing. Don't listen to the person at work who is, by day a computer programmer, but also has some opinions on the economy. Fine, hey, I'd rather be talking about that kind of topic than something that's not as intellectual. So it's good to have those conversations, I guess. But what I'm saying is, who do you really listen to? At least go, in my opinion, to the experts. And so a good starting point that I want to share with you is Malden. Look it up on Google. It's John Malden. He has a strategic investment conference. He also has a bunch of newsletters and stuff. And so he and his group of affiliated economists, they do this for a living. Many of them have PhDs. And so those are the types of people I follow. But what's interesting is a lot of them disagree. And a lot of them think the recession is here. They think it's coming. Some of them think it's not coming. It's going to be a few more years. And so what I'm trying to say is, just because you see on YouTube that the consensus is that the recession is coming, do not believe what you read or what you see. And so the reason I'm bringing this up is because it can be debilitating. If you believe the recession is coming, perhaps you may take different actions than you would otherwise. Some of them are good. One of them, for example, is just preparing yourself financially for potentially difficult times. Hey, that should always be part of the plan, in my opinion. But in terms of deploying capital, the way I look at it, and look, maybe this is just unique to me. I'm just sharing my personal journey here on YouTube after all. I'm not sharing any kind of advice, just my personal journey. But what I have found always works for me is I follow the macroeconomics because I have to for my job. But as it pertains to my dividend stuff, I just buy. I'm averaging in every month. I'm dollar cost averaging, because if I listen to just the economists, I probably would never buy anything, because they can never agree on when the recession is coming. And once they say the recession is here, oftentimes it's already over with. And so that is some important perspective just to keep in mind. Which brings me to perspective number 3 today. S&P 500 index fund investors. I talk about them here sometimes. Quite frankly, sometimes I say, hey, I don't really like that strategy. The strategy I like is completely different. I like to pick my individual stocks. I got a lot of reasons for that. But I want to give a shout out today. I want to give a thug life. I want to give props to people who are these type of investors, because I'll tell you, what these guys do right is they have a strategy. They're buying the index. And honestly, most of them, they just have a percentage of their paycheck goes in there every month. Are they worried about yield curves? Are they worried about unemployment? Are they worried about macroeconomics? No. Maybe some of them are, but I would say a lot of them are out there living their life. They're out there living their best life. And I got mad props, mad respect for those people. And let me tell you, I am a finance geek. I love dividends. I'm a dividend geek. I spend a lot of time on dividends on my YouTube channel here, in my life. And I do it because I'm passionate about it and I love it. And it does take up a lot of time for me. But one, dividend investing doesn't have to take as much time as I put in. I'd say I'm a corner case. I'm an evangelist, if you will, for the entire means of investing. Just spreading the message that, hey, dividends are interesting and if someone's looking in the world of investments, maybe they ought to consider looking at dividends. But the point is, I spend a lot of time on this, and I do the macroeconomics because I have to for my job. But is it a wise use of time for folks who are just getting started with dividend investing, worrying too much about the yield curve, worrying about unemployment, GDP, trying to figure out the national debt, and is there going to be a debt jubilee, and what is modern monetary theory, and is that going to come to fruition? Is the Federal Reserve Act going to get amended so that modern monetary theory can work? Does it make sense to look into all of these things? Maybe, but I'm just sharing from my personal perspective, probably not, and I'll tell you why. Unless you are very passionate about those topics, I believe it takes away from life. And at a certain point, it's good to be apprised of what's going on in the economy. It's good to be wise, have an emergency fund, be prepared for the worst. But what I've always found in general is I like to assume the best. I understand bad times do happen. I've been through a lot of bad times, and I like to manage my finances so that even during bad times, meaning the markets crashed, I can continue to buy stocks. I even did a video here before. I've personally faced bad times. During the last Great Recession, I faced a layoff that I had to deal with. It was very embarrassing for me, and after going through that, I would say it shaped a lot of the way I live life differently. I'm even more frugal, more cautious with money than ever before. I'll link in the description of that video if you've never seen it. It's one where I get real with you. Look, I'm sharing something very embarrassing, but it's true. I got laid off, and so I know hard times. But what I'm trying to say is just be careful where you spend your time, because sooner or later it is a slippery slope. And if everyone out there becomes an economist, what ends up happening is it becomes all-consuming. And then it's all dividends all day, all the time. And isn't the point of all of this stuff to live off of the cash flow? Isn't it just a means to an end? Isn't it just to get you from here to here? At least that is what it is for me. I'm passionate about it. I love it. But I can't lose that perspective. And certainly I don't want this message to be taken wrong. Furthering one's education is a very important and noble thing. I try to learn new things every day, especially about finance, stocks, even the economy. But I'm just saying everyone out there will find their own cutoff point, but you gotta find it. You gotta find that cutoff point, because sooner or later you're trying to learn all of the details of modern monetary theory, and does it really even get you where you're going? And then it brings me back to the S&P 500 index investors, and are they living a more enjoyable life than the person who gets too consumed with all of these details? And does getting consumed with all the details, given the average portfolio value that some people have, doesn't make sense? Is it a good use of time? Look, I have no one right or wrong answer, but I'm trying to provide perspective because I see stuff happening out there where I believe it could create financial burnout. Literally just burnout, because it's too much. It's too much. Okay, now I want to close out with the best perspective of all. And so I'm a real estate developer, and I want to walk you through what developing a commercial real estate property looks like. It actually has about 12 steps. Well, there's thousands of steps, but it's 12 big steps, milestones. And the reason that I'm bringing this up is when I invest in commercial real estate, money goes in, a lot of money goes in, tied up, don't even have a hope of seeing any cash flow for 6.25 years at the earliest. And so the reason I want to share these 12 steps is I believe the stock market, it's a gift and a curse. You put money in, you see the next second what's happening with that money. But imagine if you put money in the market and you couldn't even really look at it, you didn't really know what it's valued at. You know you're not going to even get cash flow for 6+ years. How would that change the way you do things? How would that add a different perspective? How would that ease your worries about a potential recession? This black box investing style, if you will. Sometimes all this real-time information is good, and sometimes it's great because like with 3M, I keep averaging down. And what's great about it too is instantaneously, I buy a dividend stock, I'm eligible to receive dividends right away, so the cash flow is coming in. So there's many good things about the real-time nature of the market, but there's bad things as well. And I think the bad things goes back to my last point of all inclusive, all consuming. And so let's just talk about this. I got it over here on the whiteboard, a little graphic for you all. So the first step in commercial real estate is I literally have to find the perfect property. Finding the perfect property could take, I put 1 year. Sometimes it can take more. Oftentimes finding a property isn't good enough. I might find it. It may not be zoned properly. The city may not want to be able to have a certain use case there that I want. Have to go on to the next and the next and the next. Honestly, I'm looking at dozens and dozens and dozens of properties before finding one. Finding that one property, it could take up to a year, sometimes more. That's step one. Step two, hey, I want this property. Now I got to negotiate it. Now I got to work with the seller. I need to find a fair price. I need to go back and forth on letters of intent and purchase and sale agreements. That could take up to 3 months. Okay, now I've got it in escrow. Escrow can take a long time because when it's in escrow, I got to look at the soils report. I got to look at geotechnical analysis. I got to look at entitlements. I got to get it entitled for my use case. I need to hire a team of architects, civil engineers, structural engineers. The list goes on. Environmental people. All of that kind of stuff. I have to assemble a team. This whole escrow process, it could be a year. And sometimes within escrow, I may even have to extend the escrow because more time is needed. I may have to go, for example, in front of planning commission at a city and get a project approved. And so this takes time. And so finally, after all of that, let's say we're closing escrow. That's at a time where partnership structures are really formalized. Money is really put into the deal from different partners, and people are figuring out how much money they want to invest in the deal. But mind you, this money has to be sitting around from the get-go because the money has to exist to lock it up, get it in escrow. Once the property is in escrow, a down payment on it is an initial purchase. It's needs to be funded into escrow. But it's really when you close escrow that you you have to fund all of escrow to pay it out, but you also have to get things in order to set up for the next step. And so the next step then is a construction loan. Okay, I got to work with a construction lender. I've got property now, but I need to my partners and I have to find a way to get a loan to actually build the property. And so now, okay, we're into construction. Let's say we're quick. Maybe we build it in about 18 months. Maybe it takes more. Maybe it takes 2 years. And a lot of people think building a building, oh, you just build it. No, before you even build it, there could be site work. You might have to grade the site. There may be utility issues. You may have to bring utilities in, for example, connect into water. There's other stuff too. There may be power lines overhead and the city may require you to underground them. So then you're working with a joint trench consultant and you're working with a utility company to make that happen. It could be very expensive. There's a lot of moving parts just on site work, not even talking about the building. All right, once this thing is built, you have to get a certificate of occupancy. You open it for business. Then does everyone just start making money? No, you have to lease this thing up. You have to get tenants into the commercial real estate and lease it up. That could take a year. You can start marketing before the thing is fully complete and get a wait list and such, but it could take a year. And that's aggressive. In the industry I'm in, maybe it could take even more to fully lease it up. Certainly in a down economy, it could take more. Okay, maybe after leasing it up, I just added another year in there to really achieve positive cash flow. So you kind of hit the tipping point where there's enough people moved in, there's enough income coming through that it overcomes the expenses and there's positive cash flow. I put another year for that. And then it's really at that point where you refinance out of the construction loan into a permanent loan. Hopefully at this point in the journey, the economy is holding up. Look, this is why I look at the economic stuff, because it actually really matters for what I'm doing day-to-day real estate. Not so much, I would say, for dividends, though, to my earlier point. But And it does, but again, don't take it wrong. Basically, I was just saying earlier, I'm trying to help people avoid the pain of becoming all encompassing in macroeconomic analysis. But anyways, then I refinance, and hopefully the refinance, if the economy is doing well, the property's worth a lot more than it was on paper. There's been a lot of value created, and we may even be able to take cash out in that refinance. And if we can take enough cash out in the refinance, we can pay back all of the money that went in, all of the waterfall like preferred returns, which gets us to the bottom of the waterfall, which is cash flow. But think about it, the economy is no good. Maybe we can refinance into permanent, but we can't unlock all of the equity that went in, at which point means all of the profits from the business, they're going to go towards paying back capital that went in preferred return. It's not even going to reach the bottom of the waterfall, the cash flow. And so that's another nuance. That's why I'm saying the 6.25 years, it may be a little shorter. This is kind of aggressive. This is a good economy, a bull market scenario. And so moving on, though, I put, say, another 6 months in a pay back the capital invested in any accumulated preferred return. And now that we're in the permanent loan, capital's paid back, pref return paid back. We're at the bottom of the waterfall. And I know I'm using jargon here. I know I'm going quick, but I've heard that my YouTube videos, they're a little too long. So I'm just trying to keep it fresh, keep it quick for people, because ultimately you don't have to remember these steps. The point of these steps is to paint a picture. And we'll get to that picture in 1 minute. All right, now we're at distribution. So step 12, we're at distributions to partners, meaning dividends, if you will, the equivalent of dividends. This, in a bull market, reasonably quick fashion, start to end, took 6.25 years. So what does this mean for me as an investor? This means for me as an investor that my money is tied up for 6.25 years, and I don't really see any cash flow off of it, if you will, until after that. And the reason for that is there's so many steps that have to go in to making it work. Now, when it does work, the cash flow can be good, because the miracle of real estate is there is the concept of leverage. And there's leverage because of the loans I was talking about. And because it's levered, the opportunity for cash on cash returns is good. But what I'm saying is it does take time. And for these first 6.25 years, literally money's tied up. I'm not getting anything from that. At least with a dividend stock, I tie it up, I get cash flow right away. Now, then one cool nuance with commercial real estate is after the property is up and running, the first priority, typically in most waterfalls that I've seen, is to pay back the initial investments and any accumulated preferred returns. And so that's a little different than dividends, whereas dividends, my money's in, it's never coming out. Real estate, what's cool is the money comes in, it can come out and be used for another deal. But I'd say that's a little besides the point here. What I'm really trying to illustrate is, what if you looked at stock market the way I look at real estate? That's how I look at the stock market. And so when I go back to the beginning of my video, trying to draw some perspective here, and I look at 3M, bought it yesterday here, it's already down here 1 day later. What if I couldn't even see that? What if over the next, like, say, 6 years or so, I'm just buying 3M monthly, don't really look at the price too much? That would be the equivalent. Had no real hopes for it. Had no real hopes for capital appreciation or even dividends for that matter. That would be the equivalent to the real estate perspective. And on the real estate perspective as well, during all these 12 steps, what am I doing? I am working my butt off. I am grinding. I am up late at night, up early, working. And my head is down. Am I worried about the guy on Twitter telling me to look at this or that as it pertains to modern monetary theory? No. I am figuring out literally, okay, how am I going to fit the HVAC system in this small office? How am I going to work with my mechanical engineer to orchestrate something that will work? And then with my installer to get it done right. I have to work on that type of stuff. And so what's the equivalent of that in dividends? The equivalent of that in dividends is find some stocks that are really good and are trading at reasonable values, have been raising dividends forever. But then grind it, work hard, work really hard to make money. keep your head down, work, work, work. Get that money, get it in the market, and keep getting it in the market over and over and over. And so, look, I'm just sharing my personal journey here, but what I'm trying to illustrate is this is a different way of doing it. So many people are spending time that they could spend either enjoying their lives like the S&P investors, or out there making more money like the real estate guys, that they're figuring out how to be an economist. And so what I'm trying to say is that's not for me. I got to do the economic stuff and I got a good grasp of it because of my job. But at the end of the day, what I love the most is getting that capital to work. And so I'm just trying to provide a perspective here. What if you looked at the stock market like real estate is for commercial real estate developers and don't even have a hope of looking at it, trying to make money off of it, cash flowing it, valuating it for, say, a minimum of 6.25 years, if not longer. In a down market, it could take 8 to 10 years to get a meaningful return in terms of cash flow from a newly built commercial development. And so that is the long-term nature of it all. And so take home, don't always get caught up in the day-to-day. Look at the long-term as well. It's all about that long-term investing. All right, everyone, a lot of thoughts today. I know I'm preaching, and so I hope you all appreciate today's video. It adds some value there in the community. I love you. If you enjoyed the video, please drop a like. Please share your thug life spirit here on PPCE, and this is Thug Life Investing, dividend investing for everyone. Subscribe means the world to me. I love you all. In terms of a disclosure, I own the stocks mentioned today. I am long 3M, ticker symbol MMM, and Home Depot, ticker symbol HD. This is really important. In terms of a disclaimer, this is not investment advice. I'm not a licensed investment advisor. Today's video is just for fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Literally just sharing my journey here on YouTube for fun and entertainment. And I always have in the description below more disclaimers, so check those out. All right, everyone. Let me know in the comments below what you think. I think I'm going to start a debate here. I think I'm going to start something interesting. Hope I didn't offend anyone. I don't have the only path. I know there's other ways to do it, but I'm preaching my style today because I have a unique perspective to share. I love you guys. I will see you in the next one.